Hello everyone. This lecture we are going to study chapter 3 about financial ratio analysis. So in this lecture we are going to study several ratio analysis, including profitability ratios, asset utilization ratios, also called activity ratios, and liquidity ratios, debt utilization ratios, also called leverage ratios. We also study DuPont analysis and then do peer comparison and trend analysis. So for profitability ratios, it measures returns on sales and total assets or invested capital. There are several ratios we wanted to introduce in this lecture, and profit margin, which is also called returns on sales, is net income divided by total sales, and return on assets, also called return on investment, return on equity, and basic earning power. Asset utilization ratios measure how well the firm is managing its accounts receivable, inventory, and long-term assets. So asset utilization ratios include receivables turnover, average collection periods. ACP is also called days sales outstanding. Inventory turnover, and the fixed asset turnover, total asset turnover. Liquidity ratio measures the firm's ability to pay off short-term obligations at maturity. Liquidity ratios include current ratio and quick ratio. So the quick ratio has to subtract inventory from current assets and then divided by total liabilities. Debt utilization ratios measure the prudence of the firm's debt management policies. Debt utilization ratios include debt to asset ratio times interest rate earned times interest earned, fixed charge coverage. So for those profitability ratio, so we can also do DuPont analysis. The DuPont analysis is a more clear picture to show the logic between each profitability ratios. For example, we can get profit margin, use the net income divided by total sales, and using that total sales divided by total asset, we had asset turnover. And if we times my asset turnover with the profit margin, we got a return on assets. Okay, the return on assets divided by 1 minus the debt divided by total assets, we got a return on equity. So this is a very good tool for you to learn the relationship between different financial ratios, different profitability ratios, and easy to do the calculation. Why we do that? So because the ratio analysis will factor out the size of the firm. So we can do a comparison of each individual company with the industry average. For example, we calculate all the ratios in each category. And for section company, so we calculate those ratios, and then we comparing that ratio. For example, profit margin for section company is 5%, and comparing to the industry average is 6.7%. And you make a conclusion to see how that companies manage their assets and how the company make profit. The last slides tell you trend analysis. So the trend analysis is going to do a comparison of that ratio along the timeline. For example, we can see profit margin changes from 1998 to 2010. So instead of we doing the comparison of that company with the industry average, so we can also check the performance of that firm along the timeline. So what happens in the past and what's going to be in the future. Thanks for listening.